According to a recent study by OCBC, 36% of Singaporeans invest in the Singapore stock market, while the most popular ETF being the Straits Times Index ETF. However, while the S&P 500 has been delivering some fantastic returns over these past 10 years, the STI has been rather meh. So, is this still a good idea to invest in it? That's why in this video, we'll be looking into why the STI has been so flat for so many years. Why are there still so many people investing in it despite the low performance? And more importantly, should you invest in it or stay far away? But before I start, do join my 8,000 members Telegram chat group to discuss or ask any questions that you might have. For those who do not know, the Straits Times Index is a market capitalization weighted index that tracks the performance of the top 30 listed companies on SGX, like your DBS, UOB, Singtel, Singapore Airlines, and so on. The word market capitalization weighted index just means that each of the holdings is weighted according to their size in their market. So, for example, DBS has a market cap of $101 billion, which is way bigger than Keppel Limited, which only has a market cap of $12 billion. As a result, DBS has a weightage of 23% in the index, while Keppel Limited has just 3% weightage. As mentioned earlier, the Straits Times Index hasn't gone anywhere since 2008. Basically, it has been stuck in a lost decade for the past 16 years. But the weird thing is that the Singapore's economy has been growing steadily throughout the years. In fact, the growth has been greater than the US for the past 2 decades. So what's going on? The STI spoil liao? No lah, of course not lah. The short answer is that the stock market is not the economy. If we look at the sectors of STI, we can see that a huge part of the index is in the financial sector at 53%, followed by real estate at 17%. Meanwhile, if we look at the industry breakdown of the Singapore economy, finance only takes up 13.8% of the GDP, while real estate is only at 3.1%. This shows that the market and the economy are two separate things. On one hand, the market is just a leading indicator showing where investors think the economy will go in the near term. And on the other hand, the GDP measures the actual output of the economy. But then, it still doesn't explain why STI has been so flat for so many years. Didn't the banks and some other stocks have been delivering some fantastic returns all this while? The biggest reason why STI hasn't been growing at all is because the top companies in the STI have slow or no growth. If we compare the 5-year average revenue growth from some of the top companies from S&P 500 and STI, we can see that 7 of the top 10 spots are occupied by companies in the S&P 500, like your Nvidia, Amazon, Meta, Google, and so on. This shows that the companies in S&P 500 have better revenue growth as compared to the top companies in STI. In fact, companies like Jardine Matheson Holdings and Singtel had average negative growth for the past 5 years. Likewise, if we compare the 5 years average diluted earnings per share, we will see a similar situation, where 8 out of the top 10 spots are occupied by S&P 500 companies, indicating they have better earnings than the companies from STI. And this is important because just the top holdings of STI alone have already taken up over 74% of the index. So even if there were other faster growing companies in STI, they won't be able to affect the index as much due to their smaller market cap. Another reason as to why STI gave low returns is due to its biggest sector, the finance sector, which takes up about 52% of the index. Meanwhile, the biggest sector in the S&P 500 is technology, which takes up about 30% of the index, while in STI, technology is just a tiny 1.19%. Tech companies generally have a much higher growth as compared to finance companies. For example, this chart shows that tech companies outperform financial companies over the long term. Likewise, if we look at the top performing ETFs in the world, all of them have something to do with tech. This is because the technology sector is driven by constant innovation, where it often introduces groundbreaking products or services which capture significant market share rapidly. This leads to rapid expansion and higher revenue and thus higher growth. Finance companies, on the other hand, traditionally operate with physical branches and hence would be unable to achieve the same scalability that tech companies have, and thus they have a slower growth rate. However, this is starting to slowly change with the rise in digital banks. Quick pause. If you are looking to trade options, you can check out Webull. Webull charges a low fee of just 55 cents per contract and zero platform fees, which is cheaper than many of the other brokers out there. Besides that, Webull also lets you streamline the options trading process by having a whole corner of app dedicated to options. For example, there's option statistics and probability analysis tools, where you'll be able to view data such as volume distribution, volume analysis to help you better analyze your probability of success even before making a trade. There's also the Zero DTE Options Center, where you'll be able to easily track net premium trends of long and short option contracts to quickly locate investment opportunities. Right now, Webull is running an options trading promo, where both new and existing users will get to enjoy US options free commission whenever you trade a minimum of 100 option contracts monthly. In Webull's latest welcome promo, if you use my exclusive link to sign up, fund, and trade, and fulfill the respective criteria, you'll be eligible to get up to $400 cash vouchers. You can also get up to 7% per annum yield for USD Money Bull when you fund a cap of $100,000 for up to 90 days, where you can potentially untap a yield of $1,750. This promotion is eligible for new users only. Otherwise, if you are an existing user who has not transferred any shares into Webull before, you can take part in the Transfer In promo, where you can get anywhere between $50 to $1,500 trading vouchers when you fulfill the requirements. So if you are interested in taking your investing to the next level, do sign up to Webull using my link down below. Alright, let's get back to the video. Besides the STI having much lower growth, the other issue is that there's a lack of diversification in the index, as it has only 30 holdings, and just the top 3 holdings alone already took up 40% of the index. In contrast, the S&P 500 has a whopping 500 holdings, and the top 3 holdings only occupy 17.75% of the index. Yes, it's still quite heavy, but it's a lot less concentrated as compared to STI. This is especially risky for the STI, given that 50% of the index is in the financial sector, which is also a cyclical sector. So while the financial sector is doing well during high interest rate environments, like right now, things might look very different when interest rates go back down. However, with that being said, the truth is that the STI is not totally useless, where it just gives zero return. Why? Because of dividends ma. So if you include the dividends paid, you will see something really interesting. The annualized return will increase from negative 0.39% per annum to 1.73% per annum. And if you reinvest the dividends, with the magic of compounding, the annualized returns will increase even further, from 1.73% per annum to 2.31% per annum. But of course, if we compare the STI to the S&P 500 with dividends reinvested, SPY will still beat STI by a long shot. But what if we factor in the currency exchange? Since SGD to USD rate did become stronger, if we factor in the currency conversion, the annualized return of SPY did drop slightly to 8.99% per annum, but is still higher than the STI with dividends reinvested. Next, other than the dividends, there are actually a few tax benefits for investing in STI as compared to S&P 500, with the first being the dividend withholding tax. If you are investing in US-based ETFs like SPY or VOO, 30% of the dividends are taxed before they are being paid out to you. Or even if you are investing in Ireland domiciled ETFs like CSPX and SPYL, there's still a 15% dividend withholding tax. This is actually quite significant, especially if you are planning to rely on dividends as a source of passive income. On the other hand, there's no dividend withholding tax for the STI, which means you get to keep all the dividends that are paid out to you. So that's nice. Next, the other tax benefit for investing in STI is that there's no estate tax. Whereas if you are investing in US domiciled ETFs like VOO or SPY, there's an estate tax of up to 40% on your US assets when you pass away. Oh, sorry, it's no longer your assets, it's your descendants' assets now. So to avoid that, you could either invest in Ireland domiciled ETFs or Singapore-based investments. Besides that, there's also no currency risk when investing in STI, as they are denominated in SGD. This is unlike investing in overseas markets, where if the Singapore dollar becomes stronger while the overseas currency becomes weaker, your returns would be reduced due to the currency conversion. Lastly, while it's true that STI has lower growth, it also has lower volatility as well. For this, we can look at something called beta, which measures the volatility of the security as compared to the markets. STI has a beta of 0.65, while S&P 500 has a beta of 1, which just means that STI is less volatile as compared to the S&P 500. But of course, it doesn't mean that STI won't crash hard when times are bad. For example, during the Great Financial Crisis in 2008, the largest drawdown of S&P 500 was at 49%, while STI saw a 52% drawdown. However, with that being said, if you are investing in STI for the dividends, the volatility won't matter too much to you, since you are being paid dividends no matter what. So now, should you invest in the STI or should you stay far, far away? Okay, it mostly depends on which life stage you are in, as well as what your investing goal is. If you are looking for a consistent source of passive income, then STI is for you. STI is paying out stable dividends of around 3 to 5% a year, with its 10-year average dividend yield being at 3.85%. In contrast, the S&P 500 10-year average dividend yield is a lot lower at just 1.84%. This would be good for people looking to have dividends as a source of passive income, especially retirees whose priority is to preserve their wealth instead of growing their wealth. And yes, while it's true that STI has gone nowhere for the past 16 years, it's also true that STI is a lot more stable as compared to the S&P 500. And this fits in nicely for retirees who may not be able to tahan the volatility. Because later market crash, then you know. And oh yeah, not having an estate tax means that you can pass down 100% of your assets to your descendants when you pass away. On the other hand, who shouldn't invest in the STI? As hinted earlier, if you are looking to grow your wealth a lot faster using the magic of compounding, S&P 500 will give you a better return as compared to STI, historically speaking and not guaranteed of course. Plus, because the S&P 500 is a lot more diversified across more companies and sectors than the STI, you'll be able to reap the profits no matter which sector does well. And the effect of one company or one sector doing badly will have a lot less impact. But then you might say, but it's a lot more volatile. Yes, while the S&P 500 is a lot more volatile, if your investment horizon is long enough, you'll be able to hold out and wait for the market to recover. For example, historically, if you were to buy and hold the S&P 500 over 15 years, you will not see any negative returns. This is also why the S&P 500 is more suitable for young investors who have a long investment horizon. Anyway, that was a quick video on what the Straits Times Index is, what happened to it, and who should invest in it. Hopefully, you found this useful. Like, share and subscribe as I'll be hosting new videos every Monday, Wednesday and Friday.